Hi everyone, it's Joe Duffy. The date is October the 11th, 2014, and this is a short 15-minute video, or under 15-minute video that we're doing for AMP trading. Thanks for AMP for having me, and hopefully that everyone gets a little bit of information out of what we're trying to pass on today. First, a little bit about myself. I've been a proprietary trader for one of the world's largest banks, and the chief trader for a registered CTA. You may have also seen my articles in Active Trader magazine and Futures magazine. My website is jdtradingsystems.com, which is up on the screen right now, jdtradingsystems.com. If you have any questions about anything today that we talk about, whether it's related to anything at the website or not, please feel free to click on the bio contact information at the top right there, and we'll be more than pleased to answer any questions you have. Okay, let's jump in first to a couple of techniques that I hope will help you in your own trading. I'm a big believer in having a loose stop. Certainly, I do agree that controlling the size of your risk is the number one factor in determining your overall success. What I'm going to show you today is perhaps a way that is outside the box or different than what you may have heard is the best way to control risk. Let me start off by saying that close stops, and some people wear their close stop like a badge of honor. Oh, I'm trading with a 1-point stop in the E-mini. Well, great if you can do it. It's not my cup of tea. What I found is, experience-wise, watching other people do it and certainly testing it with various systems, is that close stops will lead to the death of 1,000 cuts. You'll continually being stopped out such that you'll lose a lot more money being stopped out in small bits than you would have had you used wider stops and given your trades a little room to work. Now, having said that, I do use a wide stop, a disaster stop if you will. So how do we then limit our losses, if that's the most important thing that we have going for us to be successful over the long run? I've got a couple yellow boxes up here, and they aren't just to highlight the principle of what I'm going to show. Let's say that we got in at the beginning of this yellow box here, the first yellow box on the left, and the first couple 3 bars that's inside the box. It goes our way a little bit, comes back offside, goes our way again a little bit more, and then comes back offside. And at one point we're probably down a couple 2.5 points in the E-mini S&P here. And these are very short-term charts, so that's enough to start to get you worried. So I've got a 7-period moving average up on the chart. The 7 is, there's no magic number on that. I'm not saying that it's the best, but if the market rallies back above the 7-period moving average here, all right, and I'm still offside, then I get out. So 2 things have to happen. I'm long, the market's gone against me, it's rallied back above the 7-period moving average, and I'm offside still. I'm underwater. I'm losing money. Okay, then I get out. In this case, probably going to get out with about a 0.5 point loss on the E-mini S&P versus 2.5 points of where it was. Okay, so my stop would have been down somewhere wide down here, and I just use the principle of mean revision, which is going to help you 90% of the time in the market. And excuse me, and when it mean reverts and I'm still offside, then I get out because that tells me that that trade was probably wrong. Similarly, on the other side, if I get short in the first couple bars of this yellow box on the right, goes offside, comes back below the moving average, and I'm still offside, then that tells me that this trade's probably wrong and I'm just going to get out. So rather than getting stopped out for 2 or 3 point losses here, what I'm doing is saying, okay, doesn't look good, and if it comes back and shows me a little upside momentum, I'm not going to worry about whether I'm breaking even or anything like that. I'm just going to get out. The market doesn't know where I got in. All it knows is what it's doing. So I take advantage of any of those mean revisions. So instead of, again, losing 2 or 3 points here and 2 or 3 points there, I've probably lost a point altogether. All right. So by using that wider stop, it's going to give your mean revision probabilities a chance to kick in. Now, once in a while, that disaster stop's going to get hit, and sometimes you just have to feel it. It's going to, and maybe try to get out before that. But regardless, I do have trades where my disaster stop gets hit, and my experience is that it's still better to trade like this. Okay, one related topic to that is multiple contract trading. If you've got 3 or 4 or 5 contracts, I see people sometimes say, well, I'm going to take the first one off to cover my commissions. So I'm going to take a $20, $30, $40 profit, whatever it is, on one contract. Well, what you have to realize when you're trading multiple contracts is that each contract in your grouping is a separate system or a separate strategy. And as such, each one of those strategies has to stand on its own to be a meaningful part of contributing to the whole. So if you're taking $30 or $40 profit on one contract, that means if it was the only contract you had, it'd still have to be a winning strategy. That should be obvious. But a lot of people still do it. And I don't believe that if you're taking $30 profits on a contract, that you're going to make money over the long run, because every time you're not even going to get a $30 profit. Sometimes it's just going to run right against you, and even if you're right 90% of the time, it's unlikely you're going to make enough money to really make that a reasonable strategy. So just be careful about that and make sure that you view each strategy or each contract as a separate strategy. Now, taking multiple contracts is a good idea with varied exits for one reason. And that's because we never know what the market is going to do. Is it going to be a runner this time, or is it just going to give us a little bit? So what we try to do with our exits is balance them. If there's a higher probability that it's going to only give us 3 points most of the time, then most of our contracts should be coming off there. Holding one contract of the 4 or 5 is a 20% probability, then that it's going to run to 10 points, then that's how many we should be holding for that one contract. So we want to balance that, how far the market may go with how many contracts that we're holding for each probability. But each one, again, has to work as a separate strategy. Okay, I hope that's clear, and I hope particularly clear the strategy with the moving average and the mean revision, okay, and the principle of using wide stops. Okay, one other thing I wanted to show you here. Obviously, Twitter's a great resource. Here are people that I follow on Twitter right now, and it's probably going to change because people come and go on Twitter all the time. I tweeted for a while myself, and I just got tired of doing it. So, and I'm sure some of the people I'm following now, that may happen to as well. But here they are. They have the characteristic of not tweeting so often that it clutters my my feed, so that you can actually keep track of what people are saying on there. But pretty useful. Mr. Top Step, I think, has over 1 million followers, and they have some good stuff on their website, and definitely worth following if you're a futures trader. John Kicklighter is really good if you're trading foreign exchange, currencies, and so forth. Okay, so not very many guys. There they are. I'll scroll up again so you can write them down. That's it. I hope they help. There are some guys that are passing on useful information among these people here. Okay, got back into trading this week. Took the summer off and spotty, but this week the market got very active, so I had to get back into trading the E-mini here. These are my trades. Started trading again on Wednesday, and I will trade sporadically. I'm going to for sure trade next week because I see another volatile week ahead. And in fact, if anyone wants to see my statements for the coming week, I'll go on record right here and say, be more than happy to send them to you. And I say that knowing, not sure what they're going to look like yet. I've blocked out the quantities, obviously, but left everything else in. So you can see here, I don't like to trade. I don't like holding trades for too long unless I really think it's a strong trend. So you can see I had this one for like half an hour, shorted at 23 and a quarter, covered at 20 and a quarter, so made 3 points there. This time we're buying first, 1918, selling at 22, 25. So you have 4 and a quarter there, and so forth. If you're going to go through these yourself, you'll see that sometimes there are multiple buys. Like the first one could be a cover, then it could be a buy long, then it could be a buy long again. So you kind of have to fill in the spaces on that. That is to say, I'm not all in sometimes on my first buy. I may buy again a second lot later, or a second grouping later. Okay, so that's the last 3 days of my trading. All 3 days are, reasonably profitable. When I say reasonably, they make like 3 to 7 e-mini points a day. More than pleased again to send you what happens next week if anybody wants to see it. Okay, so that's just saying, yeah, I'm doing it. I don't do it all the time, but I do it. This is a little bit of an explanation, a layman's explanation, a simplified or dummied down explanation of the products from the website. I'm just going to go through the top one, which is our scoop indicator here. The blue histogram. If it's positive, above 0, then we're looking for buy indications, and if it's negative, that is, the blue histogram is below 0, we're looking for sell indications. The black scoop line defines the setup, and if I have a histogram that's positive and a black scoop line that's negative or below 0, that defines a potential buy setup. And if I have a scoop histogram, blue histogram that's below 0, and a scoop line that's above 0, that defines a potential, and I say potential sell setup. There is another screen that will dictate the actual entries, and we're not going to go through that today. I'm just going to show you the basic setups. The blue shading on the screen here is potential buy setups, and the yellow shading is potential sell setups. If I've actually been elected into a trade, I've put a red or a blue line down through the shading and an arrow to indicate the bar where the trend was or the trade was actually triggered. Okay, so again, first red arrow is a sell, obviously. Second red arrow, a sell. A couple more sells here. Depending how nimble you are, this was still okay. That first one actually is about, each one of these bars is 3 points, so that's a 10-point decline here. That little one after the third arrow from the left. Not every shading has a signal. Obviously, the second blue one, well, actually it did. I forgot the arrow, but the blue line is there. So yes, this second blue shading did have a trigger. Again, each one of these bars is 3 points, so even though that didn't look like it goes very far, it probably went 6 or 8 points in your favor and took a number of bars to do it, so very unlikely that was a loss, or more like a scratch probably. Okay, so again, we need another chart to actually trigger the trade, which is all explained in the absolute performance manuals and videos that come with our package. It runs right now on Trade Navigator and NinjaTrader, available for TradeStation and eSignal imminently. So that's all we have. Again, any questions, go back to the first screen, jdtradingsystems.com, and our email is there, and we'd be pleased to answer any questions you have. Once again, thanks to Amp Trading for allowing us to come in and speak to you today. Thank you very much, and good luck to everyone.